Hi, everyone, and a very warm welcome to you all joining us from many places in the world. I'm Julia Charlton, and I'm delighted to be with you today as moderator of this LegalLink FinTech webinar. I'm a Hong Kong English and Cayman qualified lawyer, and I have the privilege of being the co-chair of LegalLink's FinTech group. Well, it's really been fascinating to see how quickly the digital asset space has grown and how the regulatory side of things is changing so rapidly. To some extent here in Asia, but most radically, I think, in the US, especially during 2025. For those of you who may not know LegalLink, it's an international legal network of over 50 independent business-orientated law firms with offices in many of the world's key commercial centers. The network is Chambers ranked and comprises more than 4,000 legal professionals. It's a collaborative platform that brings together trusted expertise across jurisdictions, and that's exactly what today's webinar aims to do. We aim to share insights and practical perspectives in the fast-moving world of digital assets, and especially in the US. And the timing really couldn't be better. In the US, there's been a serious shift in how crypto and stablecoins are being regulated. We've seen proposals for a national Bitcoin reserve, new legislation like the Genius Act and the Stable Act, and increasingly active roles being taken by the SEC, the CFTC, and state regulators like those in New York and California. But it's not just about headlines or big announcements. What we're seeing is a deeper shift, I think, from enforcement-led regulation to something more structured and rules-based. That sounds great in theory, but it can also bring with it new levels of complexity, sometimes even conflicting messages from within the same regulators. So today, we're going to go below the surface and dig into some of the real questions facing everyone working and interested in the space. What should stablecoins be treated as? Are they closer to bank transfer mechanisms or more like digital payment tools? What does this regulatory reset we keep hearing about actually look like in practice? And how do we navigate a system where US federal and state regulators might be pulling in different directions? These are questions that matter not just to lawyers and compliance teams, but to fintech companies, innovators, businesses, investors, and policymakers around the world. So I'm incredibly pleased that we have two brilliant speakers with us today to help us unpack all of this. First, we have Jordan Yegley, counsel at Buchanan, Ingersoll and Rooney. Jordan brings a wealth of experience in regulatory compliance, national security, anti-money laundering, and cross-border risk, areas that are becoming increasingly important in the crypto conversation. And as well as working in the US, Jordan has in the past also worked in Hong Kong. And joining us as well is the dynamic Joe Basrawi, an attorney at Carter Ledyard in New York. Joe focuses on digital assets, emerging tech law, and IP, and he's been closely following how US laws are evolving around stablecoins and other digital innovations. So we've got around 90 minutes together, and we're going to cover a lot of ground. So I encourage everybody to take part, send in your questions through the Q&A, and we'll do our best where possible to weave them into the conversation. So let's get started. Jordan, over to you first.
Thank you, Julia. It's a pleasure to be with you and with you and Joe, and to be here presenting with LegalLink. As Julia said, I'm going to begin our conversation with a broader overview of where the U.S. has gone in 2025 and looking at the interaction between regulators, enforcement mechanisms, and even Congress to the extent that it has entered the conversation. So I'm going to share my presentation. This should probably take about 20 minutes or so, and then I'll pass it off to Joe and we'll talk a bit more about other legislation regarding stablecoin that has taken place. So where I'd like to start is with the Department of Justice, one of the chief regulators here in the United States and the chief enforcement mechanism, and its shifting approach to digital assets and crypto in particular. This began primarily after the election of President Trump, and beginning in April, there was a memo that was put out by Deputy Attorney General Blanche entitled Ending Regulation by Prosecution. So to give some context to the title there and where this memo will take us, these internal DOJ memos essentially provide the guidance for for the US attorneys in the offices across the United States on how they should proceed with their prosecutions. This focused primarily on the digital asset space. And one of the criticisms that was received both by the DOJ as well as other federal regulators that Julia mentioned, the SEC, the CFTC, was that the regulatory environment for digital assets and crypto was either non existent or those regulations that did exist were subject to interpretation, and individuals within this industry or these industries were receiving conflicting interpretations depending on who the regulator was. And because there was no solid understanding of what these regulations could mean, what we were seeing happening was that either the SEC, the CFTC, or the Department of Justice would bring an enforcement action or would send companies a Wells notice. And it was through those mechanisms that members in the industry were learning about the interpretations of what the SEC, for example, thought was a security. They found out by receiving a Wells notice saying, we believe you're issuing a product that we believe to be a security, and therefore you're in violations of the SEC regulations because, for example, you failed to register. As you can imagine, not the preferred path forward for a federal regulator to operate in a vague space and issue guidance, if I can use that term loosely, by bringing prosecutions and allowing the industry to figure it out on its own, as it were. So we issued this memo, the DOJ issued this memo, attempting to lay out some guidelines for federal prosecutors on how they should be operating in this space. And you'll see here, the Department of Justice is taking the position that they were no longer going to impose regulatory frameworks, and instead they were going to allow the regulators, the SEC and the CFTC, to bring those enforcement actions if they so choose, but those would no longer be through the Department of Justice. Now, that does not mean that the Department of Justice was stepping back from its regulatory role or its enforcement role. What it was doing was laying out the policy shift that it was planning to undertake, and we'll go through that in a bit more detail. So the first place that they focus, or the DOJ focused, is in its enforcement priorities. So you can see here, we're no longer going to target currency exchanges, mixing and tumbling services for unwitting violations of the regulations. And by that, the interpretation of that is, we believe that it is unfair, in a loose sense of that term, to industry to not be providing clear guidance and yet expect the industry to follow what that lack of guidance says or may not say. We're no longer going to be bringing enforcement actions as it relates to regulatory violations, i.e., failure to register, failure of record keeping. However, there were still areas within the enforcement network that the DOJ was going to focus its efforts. And these are areas where we traditionally see the Department of Justice bringing criminal charges or enforcement actions against individuals, even outside of the digital assets crypto space. So I've included them here on the slide. Things like embezzlement or misappropriation of funds, fraud is another name for scams, rug pulls, or hacking into exchanges. While it is of interest to know that these are the focus of the DOJ as it relates to digital assets and crypto, these regulations could apply across a broad number of industries. For example, embezzlement, we'll just take that because it's the first one on the slide, is not unique necessarily to the digital asset space. You could have that in any number of industries, and an embezzlement criminal charge would look very similar whether the individual or the entity was operating in the digital asset space or whether it was a more traditional kind of financial industry player. So that is to say, these enforcement priorities, while a focus within digital assets and crypto, can be broadly applied across the number of industries, and I think is part of the reason that is where the DOJ put its focus. Interestingly, they also went as far as to say that any open investigations that were inconsistent with these priorities would be closed. That is, if the DOJ had an ongoing investigation, for example, under a failure to register issue, that investigation would be closed by the Department of Justice because it no longer aligned with its enforcement priorities. The same could not be said, for example, if there was a hacking investigation going on. The next piece covered in the memo are charging considerations. So these are a list of priorities, a list of factors that federal prosecutors should look to when they're making determinations on whether or not they should bring criminal charges against an individual or against an entity. Again, you'll see here a lot of consistency from the enforcement priorities. That is, if there are actions that are causing harm to investors, or if there are actions being undertaken in the digital assets crypto space that are in furtherance of some other criminal conduct. Again, not unique necessarily to the digital asset space. If you had a financial institution that was in violation of, for example, sanctions that are issued by the Office of Foreign Assets Control, that could be a criminal charge that would be brought against the financial institution or their compliance officer or individuals for violations of those sanctions regulations. The same could be true if that industry or entity were, for example, operating in the digital asset space. So there's a lot of crossover here between traditional criminal prosecutions and how it will be applied to the digital asset space. Again, there's consistency in what they won't prosecute or what they should be considering when they're charging and should weigh in favor of not bringing prosecution. And you see that there at the bottom of the slide. The DOJ has said they are not interested necessarily in regulatory violations. So if there are violations of the Bank Secrecy Act or you have unregistered securities, for example, they would deem those as violations of the underlying regulations, regulatory violations, and that would be less of a priority for the department than, for example, some of the other things that we've talked about earlier. The one exception to that is if we have an entity or an individual who knew of these obligations and chose for some reason not to comply with them. While that makes sense, I think intuitively, I think there are some nuances and wrinkles there which make that charging consideration quite difficult, right? And the point I'm trying to raise there is that in order for there to be a violation which the DOJ would prosecute, the individual or entity had to know of the underlying regulation. Well, the entire purpose, in my view, of the DOJ's memo is because the regulations were not clear to begin with. So if you have an unclear regulatory framework, query how you would establish that an individual was aware of regulatory requirements and chose to violate them. So there's a bit of a cognitive dissonance there that I think within the memo, but nonetheless, that is what the DOJ has put forward as part of its charging considerations. The memo also addresses compensation of victims for digital assets and crypto transactions due to regulations, federal regulations. What has happened is we have seen in instances where investors have put their funds or money into a digital asset exchange or some crypto product, and it turns out that that product was illegitimate or there was some kind of embezzlement or fraud. Typically, the investor would be limited to recovering the funds that they had put in initially. So that is, if I bought Widget Coin at $5 and it ended up that was a fraudulent exchange or transaction, my recovery would be limited to that $5, and I wouldn't enjoy any of the benefit that Widget Coin may have seen during the time that my investment was in play. That has changed, or is at least there is interest in that changing, in that investors who believe that they are engaging in a meaningful product should be able to see the spoils of that investment, even if it turns out that there were some violations at the entity level. And then the final piece, in addition to their priorities, is shifting their resources, right? So we all know saying is one thing, doing is another. Here is where the Department of Justice is going to be putting its resources into the digital asset space and crypto. So the Market Integrity and Major Fraud Unit that sits within the Department of Justice was going to cease cryptocurrency enforcement. It is going to focus its priorities elsewhere. So this is a communication from the Department of Justice to its prosecutors saying that this unit is no longer going to be bringing criminal charges in the cryptocurrency enforcement space. Additionally, the National Cryptocurrency Enforcement Team was disbanded, no longer exists. They were taking that out of commission and moving their priorities and resources elsewhere. There are some entities or units within the Department of Justice that were going to remain. So CCIPS is going to remain, but more in a guidance and advisory role. So again, when taken together, all of these things are showing a shift away from regulatory enforcement within the digital asset space and a focus on what could be termed more traditional enforcement mechanisms or more traditional quote unquote crimes that the Department of Justice is typically seen as being in charge of prosecuting. And I will say on my next slide, I have a few examples. We have seen this memo in action, as it were. So on May 8th, we saw the former CEO of Celsius was sentenced to 12 years in prison for fraud and market manipulation. So this would be an example of the DOJ bringing criminal charges against an individual or entity operating in the digital asset space in the category of violations that the Department of Justice is typically enforcing. That is fraud or market manipulation. Fraud or market manipulation could occur in regular financial institutions, even outside of the digital asset space. Here we happen to see it in the digital asset space, and this is the DOJ making good on its promise that it would continue to enforce those kind of behaviors. We have also seen shifts away from enforcement. So on May 15th, as I'm sure many of you know, SDNY dropped its charges against Tornado Cash, certain of its charges, right? So it dropped its failure to register charge, but it maintained its violations of sanctions and anti-money laundering compliance. So here is a good example of where we're seeing the divergence between what are regulatory violations and what are more traditional criminal violations within the space of failure to comply with sanctions, failure to comply with anti-money laundering requirements. And then the same thing in May, at the end of May, we saw the SEC drop its Binance or its charges against Binance. Again, we're seeing these priorities, these enforcement mechanisms from the DOJ memo put into place. So in order to cover the amount of ground that we want to cover here with you this morning or evening, as the case may be for you, I'm going to shift away from the DOJ and its enforcement mechanisms and focus on some of the other pieces that we've seen in the digital asset space and how it's being shaped within the United States. The first piece I want to focus on is the Strategic Bitcoin Reserve. So this is something that I'm sure many of our participants and listeners have heard about. On March 6th, President Trump signed an executive order establishing a strategic Bitcoin reserve, as well as a digital assets stockpile. I've quoted some of the executive order there for you. The administration believes that there's a strategic advantage to having this Bitcoin reserve. It helps diversify some of the administration and some of the US government's exposure. And the mechanism for allowing this to take place was that executive agencies, so that would be not only the Department of Justice, but the SEC, CFTC, anything within the executive branch, were to transfer their Bitcoin to the Strategic Bitcoin Reserve and any other digital assets that it may have had to the digital asset stockpile. What is a nuance of the executive order that I think is interesting is the Secretary of Treasury and Commerce were charged with developing strategies for acquiring additional Bitcoin, which would go into the strategic reserve. The same is not the case for other digital assets. So that is digital assets which are on hand from executive agencies, or which the executive agencies might receive as part of a civil asset forfeiture, for example, or in satisfaction of monetary penalties. Those will go into the digital asset reserve, but there is not kind of an outward facing attempt to obtain more digital assets to put into the reserve. The same cannot be said for Bitcoin. There is a focus on obtaining additional Bitcoin to be put into this Bitcoin reserve. So it's a way that digital assets are being handled differently at the national level than Bitcoin is as it relates to these strategic reserves. I'm sure we'll talk about it in due time over the course of this webinar. But one of the things that I will also mention is this strategic Bitcoin reserve, as of now, has been established by executive order. That is, the president has decided to issue an executive order to establish this reserve. It is not statutory at the moment. And the reason that that's important is because if the administration's priorities were to shift, or if in a few years we were to get a new administration within the United States, assuming that legislation has not occurred in the meantime to solidify this Bitcoin reserve, as quickly as the Bitcoin reserve was created, it could be taken away with a similar stroke of a pen. So it's important to recognize that, yes, it's a signal. Yes, it's very important. But the foundational underpinnings of it are more fragile, some might say, than legislation passed through Congress would be. So it's important to note that as you're thinking about this reserve posture. And speaking of more solid foundations as it relates to legislation, the final piece, excuse me, one more thing on the Bitcoin reserve. I will say that other states have passed similar, have taken similar stances as it relates to Bitcoin reserves, not just at the national level. We have seen states follow suit. So I have here on the slide some examples. In May, New Hampshire was the first to establish its own Bitcoin reserve. It doesn't call it a Bitcoin reserve, but the reserve is permitted to hold digital assets with market caps exceeding 500 billion. At this point, that is Bitcoin, but it may not always be that case. So New Hampshire established theirs. Arizona also passed a bill, but that was vetoed by the governor. And there is one ongoing in Texas. So in addition to seeing reserves at the national level, we're also seeing them at play at the state level as well. And now I want to switch to my final piece, which is legislation. In addition to the stablecoin legislation that Joe is going to be kind enough to talk about next, there is additional legislation that is currently making its way through Congress, and that is the Clarity Act. This is a market structure bill for digital assets and for crypto. I will say that I have a few slides here on it. I'm sure that we'll get into it more in the questions. There is a lot packed into this act. I imagine much will change. I imagine much more will be packed into it. It's currently with the House committees. So we will see how it evolves as part of that process. And I'm sure there will be changes to it as it moves along and maybe receives ultimate passage. But we wanted to give you an idea of what we're currently looking at as part of this Clarity Act. So as I said, the Clarity Act is a digital asset market clarity act that is setting up a market structure for digital assets and crypto. The United States does not currently have this at the national level, hence the need for some kind of federal legislation. And the legislation really aims to do a lot, a number of things, and primary among them is to amend the securities laws to carve out what the bill calls digital commodities from the definition of a security. Now, there are many implications of doing that, not the least of which would be if the digital assets or digital commodities, I should say, as they're defined in the bill, are not securities, that would remove them from the jurisdiction of for example, the Securities Act, and also from the jurisdiction of regulators like the SEC, and shift more towards the CFTC, which is charged with regulating and enforcing regulations around commodities. If these are digital commodities, they land more in the CFTC space than they do in the SEC jurisdiction because they're not securities. That does not mean that it is a wholesale removal of digital assets or crypto from the SEC's jurisdiction. There are still spaces where the SEC will operate, but it does mark a significant shift and potentially an answer to one of the largest questions that has plagued this space for quite some time. And that is, what products, what services, what protocols constitute securities versus commodities versus neither? This has been a question that has, really plagued the industry for quite some time. And it's part of that enforcement by prosecution phenomena that we had talked about earlier on in this webinar. That is, industry participants would not know whether or not a product would be determined a security or a commodity until, for example, they received a Wells notice or some enforcement action from one of these regulators. What this bill attempts to do is clarify in which regulatory universe or regime these protocols, these products would be operating in, and to provide some additional clarity to the industry. I will say it's not perfect. It's not crystal clear. I don't think any federal statute or regulation is crystal clear, but it is a marked effort to move forward and provide some additional clarity that was lacking within the industry and within the space. So to dive a bit deeper here, digital commodities, as the bill defines them, include, as I have here, digital assets that are intrinsically linked to the blockchain system, so long as they're used for the transfer of value between participants in the blockchain system. Now, right here is exactly what I'm talking about when I say I don't think any federal legislation can be crystal clear, right? As a litigator, which is what I am at heart, I look at the first word in that quote and say, well, what does it mean to be intrinsically linked, right? These are questions that remain to be answered and will undoubtedly be further clarified within Congress and then within the judicial system as we move forward and with federal regulators. There is not perfect clarity, but you can see that we're moving towards it, or that the US Congress is attempting to apply some clarity to the system. Based on the definition as we currently understand it, this would cover the vast majority of cryptocurrencies. Um, there's an additional piece within the legislation that is designated or defined as a mature blockchain system. So this is kind of a step up from what would be a digital commodity. This would be operating the blockchain system itself, and there are requirements for that. I have a few there, that it be open source, that it be automated, that it's not controlled by a single entity, that there's no significant beneficial ownership. I mean, all of the things that you may otherwise think of when you think of a mature blockchain system are included as part of that definition. One of the criticisms, however, that the Act has received is that there are thresholds to be met here in order to qualify as a mature blockchain system. However, it's unclear whether or not the advantages of jumping over those hurdles are sufficient to encourage individuals, entities, protocols to aim for and to reach that level of a mature system. You would assume that if this was a more arduous process to get through, there's registration, there are all the regulatory requirements you might imagine, that there would be some kind of incentive or light at the end of the tunnel, as it were. Some of the industry participants and even some members of Congress have said, you know, it's great to establish requirements for a mature blockchain system, but if an industry or a participant is going to go through that process, there should be some sufficient incentives at the end. And those are not currently contemplated, at least not to the level that some think that they should be within this system, within the Clarity Act. As I said, it's currently working its way through the House committee structure. Then you have the Senate to deal with as it relates to this act. So we've had some Republican senator, or the Republican senator from Wyoming, Senator Loomis, saying that they would introduce legislation that was going to look very much like the House bill. That remains to be seen how close it will be in tone and tenor and requirements as the House bill will be. But I think stepping back and taking the 30,000-foot view, we are in an instance in 2025 where we have a digital assets crypto market structure bill that is working its way through the United States Congress. In my opinion, that is far away from where we would have been, for example, this time last year. So when we say there's been a shift in this space within the United States, that is not to say that it's been a shift to perfect clarity. It has not, or to a significant and transparent legal framework. That is also not currently in place, but it is in the works. And the fact that we have the Department of Justice issuing memos on the subject, the fact that we have a strategic Bitcoin reserve, even if it is by executive order, And the fact that we have draft regulation moving through Congress, all within the digital asset space and crypto space, marks a significant deviation from what we've seen in the past. And I think a movement forward for the industry. As these work their way through Congress, you will see industry participants, industry members themselves, lobbyists that they may engage, working to ensure that there's greater clarity within this act, working to ensure that their questions are answered. But that is all part of this process as the United States works to develop its statutory and regulatory regimes as it relates to these assets and to this industry. So with that, I'm going to pause there. I'm going to pass it over to Joe. Joe, if that's okay with you, and walk us through some additional legislation as it relates to stablecoin.
Thanks so much, Jordan. That was a great presentation. Especially interesting to hear how the regulatory priorities are shifting. So lots to think about. And as Jordan mentioned, we're now going to hear from Joe. So Joe, over to you for your insights. Please go ahead.
Thank you very much, Julia, and thank you very much, Jordan, as well, for your invaluable time and especially to LegalLink for this opportunity for us to get together and talk about these. I'd like to call it, dynamic situation, to put it lightly. And just to put an example to how dynamic this is, the Genius Act, which I will explain to the audience further, just passed, some sort of Senate approval where, long story short, the Senate yesterday said, let's go ahead and put the Genius Act to a full floor vote at some point. So that was just yesterday. So this is literally like morning time in Hong Kong. And, Julia's domain, probably got a step ahead of us here in the United States because this was towards the evening around here. So long story short, it was, this is all very, very dynamic. So what I have in front of me here is basically the title of pretty much this gathering we're here in today, which is the Great U.S. Crypto Reset. And I want to emphasize this whole reset notion here, especially in terms of the upcoming legislation coming in from the Genius Act and the Stable Act. Stable Act coming from the House specifically, Genius Act coming from the Senate. So why exactly the reset? Basically, the United States federal government is seeking to put themselves, or in a sense, reset themselves as a potential leader in the U.S. crypto world. The United States is especially interested, and I will get into more details later, in the stablecoin arena, because the stablecoin arena basically means the US dollar would get a foothold in the crypto world and could potentially factor in making the United States dollar an even greater power in terms of being the world's reserve currency, so to speak. So just want to emphasize again that we have the United States being concerned more or less with the position of the dollar in the crypto world, and in a sense, the competitors to the United States dollar, such as other crypto or virtual assets like Bitcoin, like Tether, which is the biggest stable coin in the world right now, and other virtual assets. The United States is wanting to make a more clear message pretty much to the whole world that they are very concerned and very in tune with gathering the United States, making the United States dollar a more friendly virtual asset, potentially a friendly virtual asset in the form of a stable coin. So together we will come in and figure out what this whole picture is going to shape into. And this slide essentially is a surreal art AI image that I found, where we have yet to see whether or not whether things will take shape, whether or not they will take shape in the way we expect them to, or whether or not they will take shape in a way that might surprise us. So as I mentioned earlier, there are numerous cryptocurrencies around the world, really, that would essentially compete with a potential power stable coin pegged to the dollar. And this image here is meant to portray that a little bit. Obviously, Bitcoin on the top left, you got the Ethereum logo, and you also have numerous other coins such as XRP, which is an open source Bitcoin that was held by Ripple. And for those more in tune with the crypto world than I am, Ripple was sued by the SEC and has been in a long, a very long protracted, long protracted proceedings. So as I gather my thoughts about this, there's a lot to say, really, a lot to say about how the United States is navigating stablecoins. And the easiest way to present that in a concrete manner to the audience here is through the focus in the Genius Act and the focus in the Stable Act, which I will get into right now. So bear with me while I navigate these slides with you. So what I find really funny, actually, is on the dawn of these acts being introduced, J.D. Vance, the Vice President of the United States, was at a Bitcoin conference in Vegas and made a speech where he essentially said that he viewed stablecoins, we as in the United States, we view stablecoins as a force multiplier of our economic might. And just to inject some comedy here, I found it funny that he said that in a Bitcoin conference, because if you really think about it from a long-term perspective, stablecoins, if they do end up being a preferred method for transacting virtual currencies, Bitcoin is going to take a big hit. So this is akin to a car salesman showing up at a competitor's car conference and talking about how their cars are going to be better than others. Maybe it's not the best analogy, but it's somewhat akin to J.D. Vance being a representative of a huge government coming in and telling a Bitcoin audience in a Bitcoin conference that there's this new sheriff in town, as we say, which is basically saying there's this new asset that's probably going to come in, and we're going to make it easier to administer in the United States through these acts that we have coming in. So just to put J.D. Vance's words into more focused specifics, the United States Congress takes these statistics very seriously. One of them being that the market cap for stablecoins is approaching over $232 billion as of last month. So I'm not even accounting for this month. And just to put that number into perspective, that's the current GDP of Greece, or the current GDP of New Zealand. So that's, this is nothing to take lightly. And it's something that, of course, our Congress people here in the United States are taking into account amongst the slew of other statistics that they've been presented with. Another scary one here, especially for the highlighted entities here, MasterCard and Visa, is that the transaction volume, if you define it in terms of settled amounts, for 2024, again, not even accounting for 2025, has surpassed two of the largest credit card issuers, which are MasterCard and Visa. And this is giving MasterCard and Visa perhaps a run for their money, and perhaps with more. This is me talking about how Congress is trying to view the business landscape. Perhaps Congress is wanting to put more certainty into stablecoin usage so that companies like MasterCard and Visa could come in and not basically have a better idea of how to perhaps formulate their new products around stablecoin or formulate their new systems around stablecoin. This is me speculating a little bit and not reading into the legislative history too much, but perhaps it's something that I think we can all agree would make Congress concerned and would make big companies like MasterCard and Visa wanting to speak with Congress a little bit more about what's going on. So again, amid me trying to put all the overwhelming thoughts into digestible bits here, we have two acts that are coming in through the United States Congress, one of them being the Genius Act, which I'll talk about first, and one of them being the Stable Act, which is from the House. I'll talk about the Genius Act first because that one is a little bit more mature. The Senate has put a lot more work into it in getting it to the floor, whereas the Stable Act just passed the committee phase and is still a little bit more, how can I say, more of a Play-Doh or more of like a clay that's being formed that could change, in the next week or so. So I'll So I'll dive in more into the Genius Act, and we'll explore it together as best as we can with the time allotted. And this reminds me that Senator John Thune from the Senate, who is the Senate Majority Leader here in the United States, he made a speech when the Senate gave the go-ahead to put the Genius Act into the House floor, where he said something pretty majestic, I would say. He said that the legislation, that is the Genius Act, would make the United States the crypto capital of the world. Anytime I hear somebody say something would become the capital of the world for something, especially be it from a prominent senator, I would take that seriously, and I would really look into constructively question how this would play out. And with us being lawyers here, assuming most of the audience is lawyers, we need to take into account how this would affect our clients, our potential clients, and how what messages we can give based on what Congress is saying. So the Genius Act, diving in as best as we can, stands for Guiding and Establishing National Innovation for U.S. Stablecoins of 2025. And what it really does, the big highlight that a lot of people are excited about is that stablecoin issuers may decide to receive a single license from the federal government to operate nationwide, which is a big like like you're sweating and you're removing sweat from your head. This is a big deal for larger companies that have a lot of moving parts. Should you have a client who wants perhaps a simple, consistent rule book to play by, this is one step closer to that. I'm not saying it's one rule book. I'm going to get into that detail a little bit more, but it does, in a sense, bypass all of the patchwork laws that the United States has. As most people, if not everybody, knows, perhaps more than I do, the United States is 50, states, and they're sovereign to the extent that they have their own rules that don't conflict with the greater federal framework of the United States. And since the federal framework has been relatively empty on stablecoin regulation, some states like California, New York have come in and tried to make sense of regulating stablecoins in particular. Now we have the federal government finally coming in and trying to give a voice to the chaos, or some direction to the chaos. And this would be a substantial piece of advice, potential advice to clients, that they could opt for a particular federal framework if they were wanting to become a stablecoin issuer, or wanting to purchase stablecoins, anything in between of that. So, like I said, there's a more nuance to this than just having a single passport, so to speak. There's this notion in the Genius Act where they divide issuers by how much money that they have in circulation. So smaller issuers of less than $10 billion can select one of two things. Either they can select a federal oversight under the Genius Act, so just following as a metaphor, a rule book from the feds, or they could opt for a state regulation that is federally certified. And without getting into the weeds of that, sometimes the states may have either more or less stringent requirements, depending on what state you're talking about. And for some particular issues, they might prefer a particular state's setting because maybe the federal one is a little bit too complicated, or maybe they're already registered in a certain way with the state. So this is a nuanced issue that that I may not have time to talk about, but nonetheless, there's perhaps particular reasons why the Genius Act has it this way. Perhaps smaller issuers, for example, would again prefer to just go with a state regulation that they may already know about, or maybe because it's less expensive. There's numerous details that I won't have time to go into, but this is a key provision for everyone to remember when they're talking about let's say a potential client who either wants to be a smaller issuer or wants to deal with a smaller issuer. Another one is, so the other tier is essentially a go big or go home sort of mentality, meaning that if you are an issuer that has more than $10 billion of stablecoin in circulation, you can't willy-nilly decide you can't decide what state to use. you have to go by what the Genius Act considers federal regulation. So you can't just because one state is more convenient for you, too bad, so sad. You can't do that. It seems to me that the Genius Act is doing this in particular because, again, they're very concerned with the state of the US dollar. And if the US dollar with large issuers was to have a sort of domain in a state versus the feds, perhaps that would cut against the message of the federal United States government wanting to make US dollar stable coins, aspects of a capital crypto world, one in which the US is the capital. So to tie it all together, the passport image that I'm putting on the right makes some sense here because what the Genius Act is doing is trying to add more certainty. So in the same sense that you have a passport in your hand and you show up at a border, you'll know exactly how the passport may play out. It may not be the best metaphor though, because just the text on screen, shows there's more nuance as to what regime of law you would choose, and depending on how much money you have, as well as what particular choices you make in the paperwork that you file and the reporting requirements you care about more. Should you deal with the states versus the feds, or if you deal with the feds, how the feds would react to those filings. So one key particular one that I'm also going to dive into, and this would be helpful perhaps for potential client work, is how the Genius Act mandates a 1-for-1 cash and treasury reserve. So the first question that popped into my head, at least, is what exactly can comprise those reserves? And the Genius Act does mandate in a very clear list what those reserves ought to be. And just as a preview for everybody, the reserves are very favored to being mostly US dollars. So let me get into that as best as I can. So the Genius Act, let's concentrate on the bottom half of the slide here. So the Genius Act lists down at least 5, I'm counting here at 7, reserve types that are allowed, that a stablecoin issuer is allowed to hold in order to comply with the Genius Act should it pass. And we notice, for example, that most of the reserve components are basically US dollar oriented. Obviously, US coins and currency, meaning US cash, US dollars and cash, treasury bills of the United States, repos backed by the US Treasury. So essentially US backed forms of money. And there is some room for the reserves to comprise foreign currency. So, for example, demand deposits at foreign banks, as well as central bank reserve deposits. There is room for that, but when thinking about this and thinking about the practical implications, say for a stablecoin issuer, if a stablecoin issuer were to only have reserves entirely in foreign currency, there's practical issues with obviously currency rate exchanges and the value of the dollar at a given time and how the market works and whatnot. And there's also the notion that, of course, you want multiple sources for your reserves. You can't just have a plan to be a stablecoin issuer and then decide I'm only going to have foreign currency reserves. That's not going to be sustainable. And should you be, for example, seeking investments or seeking participation from others, you're going to want to appear diversified. So the idea that most of the reserve components are US dollar oriented practically encourages potential stablecoin issuers to consider having perhaps most of their reserves under the US dollar, which is a very, very big statement implied by the Genius Act. And just to put this into a real world perspective, when you're looking at the Genius Act compared to what a currently existing stablecoin, which is Tether. Tether is the largest stablecoin in the world, arguably speaking. And as an example, let's say that Tether was to abide by the Genius Act. If Tether was to have 100 billion tokens in circulation, they would have to hold $100 billion in total reserves of very liquid, low-risk assets. And as I have mentioned in the past slide, those assets are probably going to be mostly in US dollars. As said, cash, treasury securities. The maturity rate of less than or equal to 93 days is explicitly mentioned in the Genius Act. Of course, bank deposits, short-term repurchase agreements, qualifying money market funds, central bank deposits. Central bank, just again to rewind a little bit, can include central banks of other nations. I think without diving again too much into the weeds here, it has to be a central bank that is, in a sense, trusted by the United States government. So obviously, you can't just have a would-be nation having a would-be central bank, that's not recognized by most nations, qualify as a central bank deposit under the Genius Act. And then just to drive the point a little bit further, you cannot have reserves in stocks, corporate bonds, cryptocurrencies, or other riskier assets. So yeah, this is just an example of that. And just to make it more daunting for anybody following Tether, should the Genius Act pass at some point, Tether would arguably not be in violation of the Genius Act, because Tether's disclosures about what they have in their reserves does not meet the 1-for-1 reserve standard covered by the Genius Act. They don't make clear whether or not they have a 1-for-1 that meets the list that I mentioned earlier. It meets that list of reserve types that the Genius Act permits. The best summary that I could find online, at least, about their reserve types is here on their website, where they mention that that they are pegged and they have a 1-to-1 fiat currency backed by 100% Tether's reserves. The key issue here is what exactly is Tether's reserves, and then this circulation tab on the right doesn't really answer that question, and we don't really know, or at least I don't really know, what Tether's reserves comprise. And again, should the Genius Act pass, Tether as a entity would have to scramble a little bit to ensure that they have all the papers showing what their reserves are, so that they could be in compliance with the Genius Act. Some additional highlights I'd like to share amid hundreds of potential highlights from the Genius Act is that properly issued stablecoins would not be treated as securities. So Jordan mentioned in his past talk here how the Securities and Exchange Commission tends to throw some uncertainty into how crypto assets are evaluated, and there are acts being contemplated by Congress where they want to carve out particular virtual assets as securities. Here we have a very, very explicit statement from the Genius Act, which says that properly issued stablecoins, so stablecoins blessed by the U.S. government, would not be treated as securities. So we don't expect any Wells notices or any sudden letters from the SEC. The Genius Act also lists specific issuers that are permitted to issue stablecoins. One of them being the federal qualified non-bank issuer. This is a particular type of issuer that may be of interest for potential clients. Let's say somebody has a startup and they want to start to administer stablecoin for whatever reason. Obviously, that startup is going to have a hard time becoming a bank, because, long story short, it's really hard to become a bank. So rather than go through all those tentacles, so to speak, the many arms of what it means to become a bank, let's just go ahead and have them qualify as a federal qualified non-bank issuer. And all you would have to do is, I make it sound easy. It's not all you would have to do. Some of what you would have to do is get approval by the United States Office of the Comptroller of the Currency. So that's just trying to make it a little bit easier, trying to add, again, a little bit more certainty for a potential client or for a potential entity wanting to play in the stablecoin arena in the United States, at least. Other permitted issuers are subsidiaries of insured banks. So if anybody's dealing with insured banks in their industry, great. Insured banks can create subsidiaries of themselves and pretty much start stablecoin oriented subsidiaries. It's pretty easy, relatively easy at least. state qualified issuers meeting federal standards. So this sort of plays into the concerns that particular U.S. states have. There's going to be particular states that want to have power in qualifying particular issuers. My guess is this form of a permitted issuer, state qualified issuer, appeases any state concerns about their power, such as California and Texas, the big states, so to speak. It's adding some respect or adding some deference to them, to the states themselves, so that state qualified issuers, as written out here, could become permitted issuers. One, and this is more of a foreshadow, one particularly stringy part of complying with the Genius Act that may make it a bit difficult, and hearkening back to my previous slide about a smaller issuer deciding between a state regime versus a federal regime. The federal regime is going to have some very complex anti-money laundering compliance requirements. And I can't get through all of them, of course, in this time that I have, but long story short, there are numerous programs that are required should you go by the federal regime, numerous anti-money laundering programs that are required for stablecoin issuers to perform, so that they can be in compliance with the Genius Act, at least the federal regimes of the Genius Act. Just to quickly walk through an example, let's say that you have a potential entity come up to you. They're a stablecoin issuer from the Cayman Islands. Essentially, the Genius Act has provided no buffer as of yet, has provided no buffer a timeline, meaning giving like a grace period for stablecoin issuers to change their ways in order to become compliant with the Genius Act. So because of that absence in the Genius Act, there's likely it's very likely that such entities like this fictional entity that I'm presenting here would have to apply for approval early, or at least prepare their papers early, so that they don't have to worry about ceasing operations within the 18-month period that is outlined in the Genius Act. So for anybody with that question in mind, this is a good way to say, get your homework done early before the Genius Act comes into play. And without, again, getting into the weeds here a little bit, assuming that this entity is not a bank, you would have to prepare the papers for them to become a federal qualified non-bank payment stablecoin issuer. It's a mouthful, but basically saying to become one type of permitted issuer under the Genius Act. And I've already talked about the one-to-one, and I won't go into the details of the liability papers and audits that they would be exposed to. That's for the hard work down the road. And let's say, again, for example, you have a United States based startup. Similar issue here, except I'm going to throw in the example of they could choose between a federal regime or, say, a New York regime, assuming New York being the U.S. financial capital. They're comfortable with the New York state of things. That's fine. Some potential work that you would have to do if you were to have a client like this is to assess which path is better for them, as well as figure out all these other details, which I won't get into given time and given just the sheer amount of complexity behind these actions. But I just have them on screen so that you have an idea of all the homework down the road should you encounter a potential client like this. And one reason I started with the Genius Act is because the Stable Act, it's again not as finalized, but also the Stable Act is, for the most part, similar to the Genius Act. There's a few wrinkles, and I'm not going to get into every single wrinkle because that would take too much time. But I thought I'd highlight some of the wrinkles, some of the differences between the Stable Act and the Genius Act. One of them is the idea that the Stable Act is giving more power to the states, and one way they do that is should a stablecoin issuer in a particular state, let's say a California, one based in California, all they would have to do when applying for particular certifications is they would submit it, and it would be valid upon submission unless the Secretary of the Treasury, a federal a federal entity rejects it. So it's assumed valid upon submission. So you just file it and you can rest easy until you get a letter from the Secretary of the Treasury. Whereas the Genius Act does not do that. What the Genius Act does is it requires more talk, so to speak, with the federal agency, and you're going to need to be more involved pretty much on an annual basis with the Secretary of the Treasury. So we can see this as more of a state latitude from the Stable Act side of things because there's just less involvement of the federal government. And I won't get into, again, too much weeds, but the essential philosophy here is that the Stable Act for submissions of certification, mostly, again, just repeating the mantra, when you submit it and you think it and you've submitted in a good faith, if it looks good to you, assume that it's good unless you hear otherwise. Whereas the Genius Act wants a more hand-holding gesture where they want to be more involved in regulating. So again, a bigger federal oversight on some of the details when administering stablecoins. So again, I won't get too much into this, but the last bullet, which I will just for the sake of emphasis, it's a little something that I discovered you can do. I'm going to highlight this last part here, and what I'm highlighting here is that the stable coin, excuse me, see, this is what happens when I try new things. So the Stable Act prohibits payment of interest or yield on stable coins. This is a really, really big deal for business reasons and, of course, financial reasons. Stablecoin has this specific prohibition, but the Genius Act does not. The Genius Act does not have such a prohibition. It's completely silent on it. Me personally, I don't know whether Genius would be amended or if anything would be brought up to talk about it. But should you support having interest or yield paid upon, you would be more of a Genius Act fan. Whereas if you don't want it, you would be a Stable Act fan. So there's some tension here between the House and the Senate bills, and depending on how fast the Genius Act goes through and whether it reaches the House, we'll see what happens. It's think of it as the next thinking about where the sequel is going to go, so to speak. It's gonna be really interesting. I won't get into too much detail again because of time, but should you have a potential client who is under the Stable Act regime, these are some rules that for them to follow, and some of the small differences that they would face versus a Genius Act world. For example, the stricter prohibition on rehypothecation, there's a shorter deadline. Again, the no interest on payments allowed. And one particular one that I will emphasize at the end, which is absent in the Genius Act, is that if another state has stricter rules, let's say your example entity here is based in New York, if New York is not as strict as another state in terms of all the regulations abounding between states, you must abide by the stricter state. So let's say you're in New York and California comes in and creates a more stricter regime. Too bad, so sad. Even though you're a New York entity, the Stable Act as a federal rule, as a federal landscape, says you must abide by the California regime. Whereas the Genius Act doesn't say anything about that. In fact, the Genius Act goes the opposite way and says, wherever you're based, if you're a New York entity, just go by the New York rules. If you're operating under the state regime, and again, if you're a small issuer below $10 billion. And again, not getting, just because of time, I'm trying to be as comedic as I can, injecting some comedy into the morning. But the point of this slide is to present to you how arms of the federal government prior to Congress potentially passing these bills, Office of the Comptroller of the Currency, which is that blue logo on the left. You have the Federal Reserve, and then you have the FDIC on the right. They have been moving pretty quickly over the past few months, issuing letters and guidance to industries, basically letting loose some hurdles into becoming a stablecoin issuer. And we have New York and California standing by watching because they are arguably the two most advanced when it comes to regulating stablecoins. So the Office of the Comptroller of the Currency has issued a letter where they essentially reaffirm all of the nice messages about how great it would be to have a bank, issue stablecoins. They've gone even further and rescinded a requirement where if a bank were to desire to issue stablecoins, but in the past they had to notify their supervisory office in writing. Now they don't need to do that anymore. Now the Office of the Comptroller of the Currency doesn't need that proof in order to give blessing upon issuing stablecoins in general. And again, without getting too much into the weeds, what I want the audience to get out of this slide is that the Federal Reserve, even before the Genius and Stable Act entered the headlines, was that they had a novel activities program where essentially the Federal Reserve would pretty much hold your hand. Let's say you have a novel activity in financing, and you want you want to avoid uncertainty with the federal rules and regulations. You would have the Federal Reserve come in and basically supervise you, or in a sense, examine your activities. And should, say, a potential client seek some tools to understand how to navigate the stablecoin world in the United States, this novel activities program is one way to do that. This year, they've had numerous releases talking about how they're looking forward to some of the acts akin to the Genius Act and the Stable Act. And to close off with one of the other federal agencies, the FDIC, there's this rescission. We're seeing this pattern where they're rescinding all these permission-style oriented regulations. It's no longer needed that FDIC supervised banks receive prior approval to begin permissible crypto-related activities. So essentially, it's more of a go ahead and so long as you're following the rules, you can continue with your activities. You don't need to ask us as a stopgate before going on. And it's very encouraging, at least for FDIC supervised banks, to perhaps innovate or perhaps move forward with their potential stablecoin projects. And just to close it off, just to again provide as much detail as possible in the short amount of time, the New York and I said San Francisco because of the gates, California already have very extensive stablecoin regulations in place. For California, they'll go into effect in 2026. New York has a bit license program that's already in place, and because the focus of this talk is on the federal side, I'm not going to dive too much into detail there. But essentially, New York has already had a pretty robust regime of monitoring stablecoins, as listed here on this slide, and they even go further to have a sort of daily attestation requirement. So New York is really in there if you are a New York if you're a New York based stablecoin issuer. And as for California, as I mentioned, I won't go into too much detail because the enforcement is next year, but they have a pretty much competing state regime to New York where they are going to have numerous regulatory checks for a potential stablecoin issuer. And of course, California and New York are standing by, wondering whether the federal government will take some of those powers away or keep those powers. Say, for example, with the Genius Act, having the two issuer state regime versus federal regime framework I mentioned earlier. I appreciate your time, and I appreciate the patience as we navigated this together. I will hand it over now back to Julia or to Jordan, as well as to the wider audience. I look forward to discussing because I think that's the best way for us to navigate this together.
Thank you, Joe. My goodness, listening to both of you, my head is popping. I don't know where to start with questions. So just as a non-American, tell me, these two acts, when are they going to be passed?
That's a really good question. I do not have, at least at this time, and perhaps Jordan does, but I do not have a sort of guaranteed timeline. My understanding is with the House, it passed the committee, and there's going to be perhaps some amendments or some chit chatter on the House floor. The Senate will have a floor vote. It depends on the priorities of the Senate. That's my take. And unless Jordan, you have some insight that I'm missing on.
No, I think that's right. I think providing a specific timeline is tough. I could say soon. I know that might not be a satiating answer, but having just gone over to the House from the Senate, and the Senate is where the real hurdles I think are going to lie. So it made it over the biggest jump. Now it goes to the House. That doesn't mean there won't be some tinkering, but I think between the final House vote and then obviously going to the president for sign off and approval, the next month or so would be my guess, if not sooner.
Right. That's for both the acts.
Yeah, assuming we
Yes.
don't have any, amendments which could throw things off course, right?
Right. And they're meant to work in tandem, are they? Because when I was listening to this overview, they don't sound entirely compatible in some respects.
That's right. Yeah, they're not entirely compatible, at least on their faces. And I think that's one reason we cannot give a specific timeline because certain amendments perhaps may need to be made so that they're not conflicting and so that we don't have more work for us lawyers trying to figure out which act is the controlling act.
Right. And is there cross-partisan support, or how is it going politically with this? Is there cross-party support, or there's some, sort of anti-finance Democrats who are jumping up and down?
That's a good question. I don't know, Jordan, if you have a say on that.
I think there are certainly people jumping up and down, Julia. This was not kind of a complete one-sided, vote with zero opposing. I will say, given that the administration has had this focus on digital assets and crypto, I think the Republican side has been largely in support. But that's not to say there aren't a fair share of supporters on the Democratic side as well. But I think if the loudest people in the room, the ones jumping the highest, would probably tend to be on the left side of the aisle.
Yes. Yeah. Wow, this is it's so interesting, isn't it? And maybe this is really obvious to a US lawyer, but with this sort of patchwork of regulation, which can be at state level, which could then passport you to the whole country, right? Or you could get the federal regulation. Is that right?
That's right. That's particularly for the smaller. So under the Genius Act, which is more spelled out, the Genius Act says if you have less than $10 billion, a smaller issuer, so to speak, you can opt for one or the other.
Right.
Particularly because, as I pointed out, some of the federal tweaks or the federal details might be too complicated for a small issuer to go through. So they'd rather be with the state because some states they don't conflict. They wouldn't conflict with the federal requirements, but would have easier reporting requirements, for example, or something sanctioned by the federal government, but it would be easier for a small issuer to follow it from a state side.
So who approves a state regime to be passported through the rest of the states?
From me remembering what I read of the act, it would be the Secretary of the Treasury.
Right. So is it possible there might be a state that passes a stablecoin legislation which is not passported?
I think that's like a showdown of state law versus federal law. If the state like Senate and House were to pass a stablecoin law that conflicts with the federal Genius Act or Stable Act in whatever form, there would be a question of what particular aspects of the state law conflict. And if so, the federal law would reign supreme because the federal government has explicitly made a law about it.
But in theory, a state might have a law and that would in that category, and therefore stablecoins issued under that law could only be sold in that state. Would that be correct?
Well, if these acts are passed, the answer would probably be no, because there would be a wide federal body of law, and the feds, to put it mildly, would be interested in something running afoul of federal rules. I don't know, Jordan, if there's a more articulate way for you to answer that.
I think you're right, and I think the fact that the federal government has to certify the state level would be a notch in its favor, as it were, and that you wouldn't have kind of Oklahoma stable coin that could only sell to Oklahomans. I mean, the idea is not that couldn't happen or that it would be impossible. I think the other thing that you might see that would be of interest is you may see states begin passing essentially reciprocity bills. That is, we're not going to enact a Kansas stable coin, but what we are going to say is that if you are operating in New York, California, or South Dakota, that's good enough for us, and you can also sell in Kansas. So I wouldn't be surprised to see state level reciprocity agreements. Could be for the positive or could be for the negative, right? We, New York, are not going to accept a stable coin that is registered in, pick your state, Rhode Island, and no insult or positives to New York, Rhode Island, Kansas, or South Dakota. I love all of them, but they all have their varying degrees of how strictly they want to enforce their financial regime.
So is it possible that issuers may and distributors may have to determine which state someone is in as to whether or not they can buy the stable coin?
Well, certainly under the Stable Act, and Joe, I didn't mean to cut you off. You've studied this more
No,
than
please.
I did, but certainly under the Stable Act, that would be necessary to determine, right? Because then, if you had, for example, you were a New York stablecoin issuer, but you were issuing to individuals in Nevada. If Nevada had stricter rules and regulations, you would need to know if you were selling into that state so that you could know what rules and regulations you may need to follow as it relates to those individuals. There may be record keeping requirements, for example.
Right. Wow. I mean, that maybe you're used to that kind of regulation, but it seems unwieldy to me to have to deal with that with instruments like stable coins that may become so predominant and are going to move so fast.
Well, and you may see, as I understand the passage, even though there is an opportunity that you could kind of opt into a state level, especially for, I say smaller, 10 billion is, still relatively large to me, but for a smaller offer, you may see someone or an entity who chooses to apply by the federal regulations anyway for exactly that reason, because it provides them broader coverage and it's less administrative work to keep track of all of the areas in which they're operating, if this blanket US passport actually is a useful tool.
Yeah, very, very interesting. Goodness. I mean, it does sometimes occur to me that, economies like California and Texas are so large that they could easily have their own currencies, actually, which of course they can't under US law. But,
Right.
yeah, it's
Right. And just my reaction to that, Julia, is that's perhaps one reason why California legislators are concerned about any federal, overreach of their rules, because they attribute their economic power to their state laws, and they don't want too much oversight from the federal government to a certain extent.
So do we think we're going to see stable coins in the US becoming a sort of medium of commerce currency, maybe potentially quite quickly? Because there's a prediction from Standard Chartered that there could be $2 trillion US worth of stable coins by 2028. And what's that going to do to banks?
That's an excellent question, Jordan. If you have an answer, I'll defer to you.
So I think, and not to play the litigator, I think it depends what you mean by quite quickly, right? I think there's certainly a stronger push under this current administration and under the regulations and the statutes that are moving forward now. I think the biggest issue that a lot of digital assets, crypto and stablecoin is providing, or one of the largest hurdles, is kind of implementation to the general public, right? I mean, everybody who's here on this call is interested in this topic, follow it closely. I wonder whether, Joe Q. Public from rural Pennsylvania, where I grew up, I don't know how far it is for him to go to the gas station and kind of scan his phone and it takes his stable coin and that's how he pays for his gas. That seems to be much further. But as far as kind of more generalized, institutionalized implementation, I think that will happen much more quickly.
Yeah, I'm thinking of trade flows. Maybe that individual wouldn't be using it at the gas station, but maybe the gas station chain that's buying the oil or the petrol might be using it.
I think you're exactly right. And I think it will it will go top down, as this most often does, right? It'll start at the institutional level. And once the ease of use is there, right, I mean, we've seen, things like Apple Pay and et cetera. Once the ease of use is there, I think it will funnel down to, maybe Joe Q Public at the gas station. That will just take more time.
Yeah. And of course, because of the requirements of it being backed against actual US dollars issued by the Treasury, this is creating just really a digital version of the US dollar.
Correct.
But it's not state issued, like there's been a lot of talk of state-sponsored digital currencies, but this is actually state US dollar backed, but with all the dynamic innovation of being issued by private enterprise. It's sort of going to be this massive pool of US dollars, a bit like Euro dollars became.
I think you're exactly right. And I think, we would be leaving out a central part of the story if it wasn't to say, obviously, the US dollar has a primary place in the world economy. And if the world economy is going to shift to digital, I think part of the legislation that we're seeing is that the United States wants to maintain its primacy even in the digital dollar space, right? And that's part of the drive behind these stable coins, or at least one could argue for sure.
I think so. Yes. Yeah. It's very interesting, isn't it? Yes. So tell me more about, is it possible under the US law to issue non-US dollar stablecoin?
Yeah, so I looked into that as much as I could, and I think the answer is yes, because the texts of both acts do not explicitly say one way or the other. What my presentation aimed to present, though, that because of the one-to-one reserve requirement being mostly made up of US dollars, so to speak, practically speaking, if you were a stablecoin issuer, you might just shrug your shoulders and say, I'll just make it dollar based because it's just so much easier for accounting and so much easier to administer and follow all these rules. But to go back to your question and to give a simple answer, the answer is you can have foreign currency pegged stable coins operating in the United States, no problem.
Right. So, for example, just if you could just quickly, I know you had that wonderful table, but say someone wanted to issue euro stable coins, they would need to hold a certain amount of US dollars, or they could hold euros in an offshore bank account on deposit.
It would be the latter. It would be, so let's say you have $100 billion, sorry, 100 billion euros in pegged tokens. You would need 100 billion euros in reserves
In a bank. So you've got
in a bank, right?
Bank. Yeah.
Right.
Yeah. Interesting. Right. Well, we have some questions from people who've joined, so perhaps I'll move on to some of these. So from Kishav Ishwar, with stablecoins often used in staking, lending, or DeFi arrangements, does the DOJ's policy imply that such multifunctional use won't be targeted unless there's a demonstrable criminal breach? I think, is that more focused at you, Jordan, perhaps?
I think so, and if not, I'm happy to take the first shot at the answer. So I think the answer is yes, and that is that unless there's some kind of demonstrable criminal breach, the DOJ is not currently interested into weighing, at least as I see it, into this regulatory muck at the moment. And part of that is there are so many unanswered questions that the DOJ doesn't feel as if it should be the tip of the spear, as it were. However, we have seen where DOJ has prosecuted based on the use of stable coins. However, those instances, and some have happened very recently within the last month, those instances was where individuals were using stable coins in an effort to further criminal activity. So that is, they were either using Tether to launder money, they were using Tether to evade US sanctions, etc. So it's still that same underlying or underpinning criminal activity. It just happens to be that in those cases, stablecoin was used as the mechanism for inappropriately transferring that value.
Right, that's really interesting. And here's another one from Kishav Ishwar. Under the current draft of the Genius Act, what key obligations would apply to non-bank stablecoin issuers seeking a federal license? Is this the beginning of synthetic banks without FDIC insurance?
So I'll take a crack at that. So key obligations, I've mentioned just some of them. There's a whole list of them that are explicitly pointed out in the Genius Act. again, to be a permitted issuer as a non-bank, there's numerous there's that application I mentioned to the Office of the Comptroller of the Currency. I didn't go into details of what that application looks like, but that's going to have a lot of requirements there. And then there's, of course, after you get approved, there's all those anti-money laundering rules that you need to have, and being exposed to audits and reporting requirements, et cetera, et cetera. The second half of this question is this the beginning of synthetic banks? I think so. I don't know if Congress would like those banks being called synthetic banks, but my gut feeling is that U.S. Congress is wanting non-banked, or so-called synthetic banks for our purposes here, to have enough trust and enough of U.S. federal blessing, so to speak, behind them, so that things like FDIC insurance are sort of in the back end. But that'll depend on, what the non-bank issuer does overall.
Thank you. And here's a question from Glenn Wijaya. Any short-term impact from the Great US Crypto Reset, which is the name of our webinar, on Asian jurisdictions in general, especially jurisdictions which are actively trading with the US?
So not to give an improperly concise answer, but I think yes, right? And the reason I say yes is the last part, right? Actively trading in the United States, right? So if there is some U.S. jurisdictional hook, that could be they trade in the United States, it is a U.S. stable coin, it is backed by the U.S. dollar, whatever it may be, those would implicate the Asian markets as well. And individuals operating even in Asian jurisdictions. So I think in the same way that we see the Office of Foreign Assets Control, right? They have jurisdiction over transactions, even if they happen wholly outside the United States but are denominated in US dollars. The OFAC has taken the position that they still have jurisdiction. I think you're going to see a similar phenomena in markets across the world. Where the US goes, everybody is watching, not always following, but everybody is watching to see what implications it has for them.
Totally. So if it's an issuer outside the US issues US stable coins, is there any mechanism by which those can be authorized to be sold in the US or transferred in the US? Or would that issuer have to go and re-register and be approved in the US to issue stable coins which are being used within the US?
I think it's the latter. In the name of being concise, the Genius Act and the Stable Act make clear that any stablecoin issuer wanting to operate in the United States needs to be permitted, so to speak. So even if you have a foreign stablecoin issuer issuing U.S. pegged tokens, and they want to even just pass through the United States, not be so-called incorporated or registered, just by issuing within the United States, though, or passing through the United States, you need to abide by the requirements of the acts, meaning being considered a permitted issuer and following the rules outlined in the acts.
Thank you. Thanks. Here's another question from Glenn Wijaya. Have you seen any movement globally in terms of how to regulate crypto that mimics how the US treats crypto assets? Have we seen anything globally? Well, I guess it's all been changing so much, hasn't it? In my personal view, I've known the SFC is constantly here referenced in the past US regulation, and that's been a moving target. And, there's this long period of sort of, well, let's try and use existing legislation in Hong Kong. And that's if everywhere else starts to follow the US, there'll be very dynamic movement on enabling legislation, I would guess. But I don't know what you guys think.
I was good other than to say I agree with you, Julia. I think in some instances you'll see countries that are waiting for the United States to make the first move, and the United States has been a little bit slow to do that. Hence the kind of shift that we've been talking about today. That said, I think there are places in the world, jurisdictions in the world, that have been more hospitable to digital assets and crypto than the United States has, and has provided some more clarity. So I think in those instances, it's actually the United States who has some catch up to do as far as what is authorized and providing clarity. So depending on what part of globally we're talking about, I think you will see the United States working towards greater regulatory clarity, a bit more flexibility, which encourages innovation. Some jurisdictions have already been doing that. Others have been waiting for the United States to dive into the pool first. And I think you'll see that after this happens or this shift happens in the coming years, you'll see more and more of them follow suit. If the United States will do it, we'll follow their lead.
Yeah, yeah.
And Julia, if I may interrupt just with this quick important point, and I know time is of the essence, just to put a specific example to what Jordan said, the Genius Act does have a provision saying that encouraging, so to speak, encouraging the Secretary of Treasury and the Department of State to work with other nations to potentially set up reciprocal systems of stablecoin issuance rules. So, say, for example, over in Hong Kong or Britain or whatever, I'm just going to use Britain as an example, as another English-speaking nation. If the UK government and the US government arms were to work together and create a stablecoin reciprocity arrangement in line with the Genius Act has an actual provision allowing the Secretary of the Treasury and the Department of State to mobilize it as quickly as they can. So, without getting into the details of that, the Genius Act does call for that specifically.
That's really interesting. We have some more questions. We're already at 9:30. Are you guys okay to carry on for another 5 or so minutes? Is that all right?
I defer to you, Julia.
Okay, let's try and get another 1 or 2 in. So here's a obviously very Indonesian orientated question, but interesting, I think. Could you please explain the main rationale for the change in regulatory oversight from the SEC to the CTFC? In Indonesia, the recent shift is happening in the opposite direction, from our equivalent of the CFTC to our equivalent of the SEC.
So I think there's an understanding in part in the United States that the CFTC allows for some broader approaches to innovation and some regulatory flexibility. The SEC's charge is investor protection. I am not suggesting that individuals are encouraged to move away from investor protection, but what I think we're seeing is that there's a belief, at least by this administration, that the SEC has been too stringent in the applying of its regulations. It has been too cautious, and that in a market like crypto and digital assets, we need to be able to move a bit quicker and with more flexibility. And I think that's why we're seeing a shift from the SEC to the CFTC. It's no secret that there's no love lost between this administration and the former chair of the SEC. I think that's quite clear. And I think they believe by moving primarily over to the CFTC that it'll allow entities operating within this space greater flexibility to innovate and build these products within the United States without fear of regulatory overreach.
Yeah.
And just to add really quick to Jordan's answer as well, the idea, I mean, it's a really great question from Glenn. Long story short, because the U.S. Congress has been issuing all these potential, bills like the Genius Act and the Stable Act, there are some perhaps experts out there who say one reason the oversight is going to the CFTC is because Congress is saying get away from the SEC. They're putting out these carve-out provisions and whatnot. So some of these letters and some of these resources are being used by business folks, to think the way you're thinking.
Yeah, so it's partly to do with the regulatory culture of the different organizations as much as the actual legal analysis, perhaps. Yeah,
I think that's right.
Thanks. So 2 parts and to another question. Do the Genius and Stable Acts do enough to ensure interoperability across issuers, blockchains, wallets, and payment rails, or are we at risk of regulatory silos mirroring technical fragmentation?
Yeah, the simple answer to that is no, it does not do enough. It gives a nice starting point, right? And it gives a nice sense of certainty for stablecoin issuers to not get, dinged, so to speak. But when it comes to all these other aspects, especially when you're mentioning the regulatory silos mirroring technical fragmentation, I like that phrase. That's not accounted for at all. At least my reading of the act does that. And who knows whether an amendment will come up for that, or if the court system here in the United States will play it out.
Thank you. And then the second part of that is, should there be federal preemption for stablecoin regulation, similar to the OCC's treatment of national banks?
Yeah, I think the quick answer is more than should, is that there will be federal preemption because of the explicit texts of these acts should they pass. But to relate it back to your first question, the big question will then be, well, what exactly is preempted, and whether or not, and then there's all these doctrines as well, and you just to make it more complicated for everybody, where you don't necessarily do a match between the explicit text. You look at the wider context of the legislation and see whether or not Congress is wanting to preempt, state regulation or any other regulation out there. I can't remember the term for it. This is like law school philosophy trying to come in a bit, but essentially, it's not a one-to-one explicit look at the text. It's a look at what Congress has been doing and the culture of Congress, the history. There's a whole slew of things, and then you have the courts also confirming that confusion sometimes.
Yeah, and I think the way it will operate is that the state laws, at least under the Genius Act, where you have the ability to register under a state, if you will, the state will be, in my opinion, that remains to be seen, the state will be more of a gap filler. That is, where the federal statutes or regulations say you must maintain records, fine. California says you have to have records for 5 years. New York says 10, and somebody decides they want to keep them for 5 as opposed to 10. So I see them as more gap fillers. Where there is kind of direct conflict, the federal regulations will preempt and will take that position. But I think there's enough gray area, if I can use that term, that there's still going to be a play amongst the states for advantages over other states in that negative space of the federal regulation.
Interesting. So it'd be dynamic competition between them. Yeah.
I believe so.
Great. That's fantastic. Well, there's more questions, but I think it is time to wrap up. So thank you, everybody who's joined us today. It's been a great privilege to moderate this great discussion. And it really stood out to me enormously how fast the regulatory landscape is changing. And these wonderful speakers, Jordan and Joe, have given such great insights into how regulators are trying to strike the balance between encouraging innovation and ensuring strong workable safeguards, although we have heard about some potential conflicts going forward between these different acts which are on the table. I think the biggest takeaway is that the US is increasingly likely to be the key player in shaping global crypto policy. Other jurisdictions, of course, at the same time are still building out frameworks, but I do think that the US is taking an amazing lead. And I think personally, I think it's very exciting. So it's really clear that as we look forward, regulation has to keep pace with this development, and presumably there may end up being amendments to these regulations, and it's going to be very interesting to see how this plays out in the courts. So a huge thank you to Jordan and to Joe for sharing your time and expertise on this Thursday morning in the States, and thanks to everyone who's joined throughout the world. And at Legal Link, we look forward to continuing this conversation. Perhaps we can do a review in a few months' time when these acts are enacted as to what's actually happening. And thank you again, wishing you a great rest of your day or evening, depending on where you are, and look forward to seeing you again, hopefully at future webinars. Thank you. Bye. Bye.